I'm going to go ahead and start with some opening remarks. There's only two things on people's minds today: making ends meet and making meetings end. So we're going to do our best to stay on schedule. Welcome to the Hospitality Law Conference, Washington, D.C., Day 2. Today is September 17th, 2025. Welcome to those of you here in the prestigious Army-Navy Country Club in Arlington, Virginia. Welcome to those of you watching live but remotely, and welcome to those of you that might watch this program on demand in the future. My name is Stephen Barth. I'm the founder of HospitalityLawyer.com and a professor at the University of Houston. I'd like to say thank you to Kensington Vanguard, the National Title Company, for their generous support for our breakfast today. Let's do a quick safety and security review. Yes, thank you. Let's do a quick safety and security review. There is not a fire drill scheduled today in the club, so if a fire alarm goes off, it's the real thing. Just please keep in mind that the elevators will not work. There is stairs, as many of you probably saw as soon as you came in, will take you right down to the lobby. But if you also exit any of the doors at the back of this room, you turn left, go straight out to the terrace. There's an exterior staircase that will take you down to the ground level. So, and restrooms, by the way, are just outside and to the left of this room. We do a lot of social engagement at HospitalityLawyer.com, so I hope you'll join us today in sharing the information. And those of you that are watching remotely, you are welcome to do so as well. By joining us today, whether it's remotely or here in person, you have access to HospitalityLawyer.com for 1 year. You can scan this QR code, and that will get you to the place where you can create a complimentary login that will be good for the next year. We also are very proud of our collaboration with MyLawCLE, a national CLE provider for the lawyers in the room. We have also created, in conjunction with MyLawCLE, a hospitality law portal. So now you can access all of your CLE relevant to hospitality at MyLawCLE. That QR code will take you to a spot for you to sign up and purchase access to MyLawCLE. For attending this program, as well as yesterday, there is continuing legal education credit available. Everything is really straightforward except for Virginia. Those of you that practice in Virginia, you know that. But if you have any questions, please see Marilyn and or the MyLawCLE folks here at the audiovisual table. So Day 2 of our program, this half-day program, is focused on Let's Make a Deal. And so let's just take a quick peek at what we're going to be doing this morning. We're going to start with some opening remarks and then the market outlook for Panel 1 and deal-making trends. Then we'll roll into Panel 2, an anatomy of a hospitality acquisition in today's current market. We'll take a quick break supported by Cozen O'Connor. And then we'll come back for Panel 3, Financing the Future, and Panel 4, Legal Landmines and Successful Outcomes, followed by a Dealmakers reception out on the beautiful terrace, supported by Ancora, Dimension Hospitality, and Fisher Phillips. Now, to start us off, to give us just an overview of the deal landscape as it exists today, is Mr. Bradley Burwell, Executive Vice President of Colliers.
Good morning, everyone, and thank you to Stephen and Hospitality Law Conference for inviting me to provide a brief overview of the current deal landscape as an introduction to today's panels. We have a distinguished lineup of experts who will explore hotel transactions, capital trends, and deal structuring throughout the day for you all. But to set the stage, I'll outline the current transaction environment and highlight just a few key trends. Can we do the slide? There we go. Perfect. There's a lot there, I know. But just to kind of summarize, in 2024, approximately 1,700 hotels sold throughout the United States worth $25.5 billion. In the first half of 2025, 823 hotels have traded hands worth nearly $12 billion, aligning with the first half of 2024. Over the last year, we've seen a 4.5% decline in total hotel sales volume, but about a 25% drop in the number of properties sold. And looking at the market with a broader lens, I would say sales volume in the last 12 months is 32% below the 15-year annual average, which is about $36 billion a year. I'd also note that although the third quarter's numbers are not out yet, the 12 months as of September will likely be down another billion or two. Regionally, I have some statistics up here that transaction volume across the United States remains well below historical averages. The South and Midwest have experienced the smallest declines and even shown year-over-year increases. This reflects post-COVID investor shifts towards Sunbelt markets, coupled with less volatility in the Midwest smaller markets, which are less impacted by macro trends. Conversely, gateway cities on the East and West Coasts have experienced significant turbulence over the last 5 years and are, in my experience, much more volatile investment markets anyway. Another notable shift is the decline in the average deal size over the past 24 months. While a typical hotel sale or a typical sale of an individual hotel hovers around $15 million, and it has for, as far as I could tell, 7-8 years, the average deal size has fallen 30 to 40% recently. You can see this as portfolio volume is down more than 45% from historical averages, and we haven't seen an entity-level transaction in the last 20 months, which is particularly important to this group. I'm going to simplify the complex transaction market into two factors. First of all, the types of capital, both buyers and sellers, and the cost of debt, which brings me to the next slide, capital trends today. Our third panel, Financing the Future, will delve into equity and debt capital and talk about this a little bit more, but I'm going to highlight just a few insights. This big graph that looks very colorful shows buyer capital sources over the years, and it illustrates a cyclical pattern, even though it may not at first glance. Sellers on the other side of deals are consistently mixed, so I haven't put them up here. I would say an apocryphal statistic that I heard years ago states that 80% of hotel investors lose money, while the remaining 20% make a lot of money and recoup all of the 80%'s losses. And if that's true, private capital, which is owners, operators, high net worth family offices, are all a meaningful part of that profitable 20%. You can tell that they tend to buy when transaction volumes are low and performance is down during crises like the Great Financial Crisis, COVID, or one could dare say today. By contrast, cross-border and REIT capital tend to invest when asset performance is strong. Interestingly, I would note that these groups are the right buyers when debt is expensive and operating performance is weak, as they use low leverage and they are long-term holders. However, they rarely invest in downturns. REIT stocks are often lower when interest rates are higher or the economy falters, and international investors pull back capital with negative economic trends globally and favor fixed income when interest rates are high. I would note that between 2019 and 2024, REIT acquisition volume is down 46% from the levels seen between 2010 and 2018. So they're doing half as many transactions as they were really pre-COVID. Host was not rewarded by the public markets for its excellent acquisitions in the last 24 months, both in New York and Hawaii, and even in Nashville. The major asset aggregating REITs of the last 10 years are all but silent or else in sell mode. Braemar, as everybody I'm sure has seen, and maybe some of you are participating in, is on the market as shareholders recognize that its assets values exceed the public valuation. And just this week, one of Sunstone's largest investors requested the company to start asset liquidation. From a cross-border perspective or international buyer perspective, each cycle has always had a dominant foreign player. The Middle East came out strong in the early aughts. The Chinese, and specifically Chinese insurance companies, came out in the early teens. And since COVID, we've seen investors from the UK, from Canada, Singapore, and Korea, who have all tested the hotel market for various reasons, but not one has emerged as a dominant force. I'm hoping that in today's panels, somebody will shed light on who the next major foreign investor is going to be so that I can call them later. Finally, institutional private equity emerges cyclically, I would say like a cicada. Private equity value often hinges on cheap debt. Recessions, downturns, crises lead to this cheap debt. And as you can see, after the great financial crisis and COVID, which are marked there with some red arrows, institutional equity funds become the largest investor in the space, deploying significant capital in a very quick period, and then they dig back in and wait for the next cycle. So now that we've gone through a couple of years of low transaction volume, are they going to come back out? We've seen, obviously, Blackstone make a major acquisition down in Miami last week, and earlier this year they've made several pretty big deals, so maybe that's a sign. Let's go on to the next slide, please. In my, frankly, oversimplification of the transaction landscape, debt is the second key factor. And today's debt markets are both liquid and more constructive than the equity markets. Lenders seek stable, predictable income that thanks to high interest rates, they're enjoying the strongest yields in the last 35 years. Lenders are much more mathematical in their analyses than equity investors, and we are at an interesting point in the cycle where we are seeing lenders value assets greater than buyers. This little chart that I put up here that I guess it's not too hard to read shows average hotel cap rates by year. And currently, investors value hotels around a 9.5% cap rate. This is compared to a historical average that, even though it doesn't look like it, I would argue is about 8.5%. Mr. Lesser will have a much better opinion of that than I do. But lenders are still underwriting the value of hotels on this historical average. And that means that they are valuing assets 10 to 12% higher than buyers are today. And as a result, lenders are often offering borrowers 72 to 75% of loan to market value, yet they're pricing it on the appraised value and on a loan at 65% of the appraised value. Next slide, please. I just want to hit on a couple of other macro trends that is impacting underwriting for investors today. First of all, travel trends. Remote work from hotel rooms during long weekends, which was driven by Zoom and flexible office policies and demographic shifts, has all but waned. International tourism to the U.S. remains below pre-COVID levels, with fewer high-spending, long-stay visitors. This trend, I think, is going to continue with both rising visa costs, inflation, and global sentiment. On the upside, airport traffic, as reported by TSA, continues to rise steadily, indicating corporate travel continues to rebound. I will tell you that last night my flight was delayed. I did a red eye, and the plane was totally full, and I couldn't get a bag in, and I was in boarding section 1. So that just goes to show how crazy it is. And it also tells me that a lot of frequent travelers are traveling, which is typically your business traveler. In terms of labor, inflation and constrained low-wage labor pool will continue to pressure operating costs. And then in international relations, which I think is much more about stability. Market sentiment shifted rapidly with initial optimism at the start of 2025 that faded by April, and although uncertainty persists, confidence is gradually returning. And by early next year, I believe that geopolitical concerns will have a smaller impact on underwriting as investors and lenders adjust to what we could call new norms. Go on to the next slide, please. Our first panel today has a great set of advisors that are going to be talking about the market outlook and deal-making trends. But before we move into that in just a couple of minutes, I want to outline a few ideas and topics that we are seeing from investors, buyers, and lenders today. First of all, what do investors want? Geographically, they are still particularly focused on politically red cities with major medical, educational, sports, and entertainment venues. From an asset perspective, I would say that cash is king. Stronger in-place income attracts more interest. Today, investors prioritize assets that cover debt service without requiring additional capital rather than repositionings. And then finally, deal sizes, as I mentioned, are currently smaller, but I anticipate that in 2026, we will see more substantial transactions, both single asset, more portfolio deals, and then the thing that's really going to push the size of the deal is we will see a return of entity-level transactions. How is underwriting changing? Our second panel, Anatomy of a Hospitality Acquisition, will explore this. But I'll note that the cost of equity has risen over the past 2 years. Leverage IRR targets today are now in the low 20s, up from the high teens at the end of the last decade. And then finally, the word that perks everybody's ears, distress. Everyone wants a distressed deal. I think that this is so much so the case that buyers typically overpay for distressed deals. Well, let me just set the stage here. CMBS delinquencies increased from $3 billion in the fourth quarter of 2023 to over $5 billion in the second quarter of 2025. Furthermore, 8% of loans are currently reported to be distressed, which is the highest level not since COVID, but since 2010, since the great financial crisis. There are two types of distressed deals, those that are operationally distressed and those that are overcapitalized and financially distressed. Operationally distressed deals are relatively consistent. They're functionally obsolescent hotels, and those just are naturally kind of coming all the time. And I used to point out that almost all of the distressed deals purchased in 2021 were distressed before COVID. But to many investors' excitement, and I'm sure to many of you, to many of your clients, we are now seeing bigger cracks in the dam holding financially distressed deals back. These are the deals that were built for too much money. They were the deals that worked when debt was 3.5%. Hotel operations have generally stabilized across markets, and although the cost of debt is expected to continue to slowly become less expensive over the next year or two, it is not expected to fall dramatically. And these factors are leading lenders to call in their loans. They are productively working with borrowers, as we have seen, because they don't want the assets back, to either sell or refinance these deals in an efficient manner. That can be achieved by allowing the borrower to control the process if it's a short sale, working to alleviate tax implications and financial burdens for the borrower, covering operating shortfalls, obviously, and we are seeing consistently that These lenders are providing some type of bridge loans to buyers or anybody who brings in fresh equity. With this broad overview, I'm going to pass the stage on to our moderator today, Stephen Shapiro. Stephen directs the Hospitality and Tourism Law Program at American University here in DC, and he teaches courses on industry economics, franchising, development, data security, risk management, and employment law. Stephen and Stephen Barth, our host here, collaborate on hospitality lawyer events and teach together in France. I encourage all of you to reach out and to connect with them about upcoming programs and also ideas of future programs. With that, I wish all of you a fantastic day, and hopefully it will get sunny for the terrace this afternoon. Stephen, the floor is yours. Thank you.
Hi, good morning. I'm going to ask our panelists to come up for the first session. We have Jared Allen, Dan Lesser, Hector, and Kyle Stevenson. For me, our session, which was a great setup by Brad, has three sort of overarching topics. It's let's make a deal, so acquisition of properties, and then along with that, we'll have a conversation perhaps on franchising. We're going to be looking at funds. Where's the equity? Where's the debt, which Brad talked about also. New development, and then our final session will be on, it's on risk, but it's also going to be gremlins. Where are things hiding? I'm going to ask our panelists to introduce themselves.
Ready to begin panel 3, Financing the Future. Take it away, Mr. Shapiro. I'm sorry, Professor Shapiro.
There we go. All right, we're back on Financing the Future. Todd, can you introduce yourself and your work?
Sure. Good morning, everyone. My name is Todd Pajonas. I'm an attorney. I'm president of Legal 1031 Exchange Services. We're a qualified intermediary. We structure 1031 exchanges. Part of what draws me here is in my career, which spans now in the 1031 industry about 27 years. We've done a lot of hotel exchanges, and more recently. And the dynamic of hotel exchanges have changed, especially since the 2017 Tax Cuts and Jobs Act, because it used to be 1031 exchange of the real estate and the personal property. Tax Cuts and Jobs Act got rid of the personal property component of that. So in a sense, it made it easier, although less tax-friendly for the operators. So for us, we're just on the real estate side. So I've enjoyed all the discussions here today, and again, what brings me here is just an ability to connect more with the hospitality industry and work more in that space vis-a-vis 1031 exchanges.
Great. We had Kyle Stevenson, who's the broker, stepped out. He'll be back. When do you I know you want to hear about a deal early. When are you working with your clients? When are you first hearing about a client who needs to do a 1031 exchange?
So it's funny, the similar question that you asked the last panel to the attorneys, when, how do you like your clients? And a lot of times we like it if a broker brings us in when an operator, when a company's thinking about selling. We have corporate relationships, and thus we're always in touch with them. But sometimes it's the smaller unit operators, and we get in touch with them more through a broker. So a lot of times there can be complications to 1031 exchanges, partnerships, people going their separate ways, et cetera. So getting in early on that discussion normally allows us to overcome those issues a lot easier, other than like when they've already signed the contract. Another topic that came up, if they already signed the contract, then sometimes I can't do my magic.
Okay, let's talk about Stan Musial. Go ahead, Mike Pickett. Tell us about baseball and your work at Venable Law Firm.
Okay, well, so I'm from St. Louis originally, and Steve always pins me down on St. Louis Cardinal questions. I'm a partner at Venable.
Can you all hear him?
Venable LLP. There we go. That's maybe a little bit better. Sorry. Mike Pickett, partner at Venable. Been practicing commercial real estate for however 35, whatever years. A lot of borrower side finance work in all product types, including hotel hospitality work.
Okay. Your clients are similar to Jennifer Nilany. You're dealing with hotel clients who want to do a franchise agreement, management agreement. Who's doing do you do the management and franchise agreements on behalf of your clients? Do you have colleagues? Mike Pickett.
That's me. Yeah, so we do have people that do that work. I don't do the management or franchise agreements directly, but we have other colleagues in our offices that handle all that.
Great. Dan Lesser, our topic is financing, so equity, debt, but we probably need to start with budget, pro forma. Tell us how you're developing, you and Jonathan, how you're developing what this thing's going to cost and how much your client is going to need.
Well, first of all, let me just say that in spite of what you may hear, there's a ton of money out there, both debt and equity. I love when I hear that, there's no construction financing out there. That's ridiculous. There's construction money out there
It's pricey.
and for the
plenty of money.
right projects. Exactly. Again, both debt and equity. What are we doing? In my world, I'm tasked with reflecting the market, right? So I remember once somebody saying to me, well, the market's frothy. I was like, okay, that's the market, right? And I'm reflecting the actions of the marketplace. So hotels are, very much a buy the dream type of mentality, right? And so it's very much sort of a forward look as opposed to a rear view mirror look, because in my 45 years, I've never, ever met a sponsor and or manager who didn't think they could do better than the prior regime, right? And so that it's a forward look, candidly, is what it is. And, I love when people talk about cap rates, right? To me, cap rates are kind of meaningless, right? If you ask me can you show me some cap rates? I'll show you deals from 0 to 15% cap rates. What do you want, right? And nobody buys a hotel saying, that's a 6.1. No, it's a 6.2 cap rate, right? And then the first question that always comes up is like, when we're talking about cap rates, like, okay, what level of income are we talking about, right? Are we talking about net income before fixed charges, net income after management fees and reserves for replacement? And if you are talking about that, well, then what are you allocating for management fees and reserves, right? Are you allocating 2% for reserves or 5%, right? And so I actually once wrote an article about a real deal. It was a $50 million transaction, and I extracted out of this $50 million transaction 8 different cap rates, because you could look at last year's income, next year's income, stabilized income, deflated, and then different levels of income.
Jonathan, how are you? Oh, go ahead, Mike.
Just one quick word on the cap rates. So in my world, we spend time on debt yield, which is sort of the same thing relative to the debt, and that, in my opinion, is more important than the actual cap rate, because the lender, everything you do in the acquisition ownership, you have to be looking at the financeability of what you've done and how many loan dollars a lender is going to give you, what recourse there's going to be, all the attributes of the loan impact all of your underwriting when you're doing your acquisition work.
For the law students here, financial literacy, understanding, you don't need to be expert on spreadsheet, but understanding IRR, cap rates. Any thoughts, Mike?
Debt service coverages, there's a lot of terms that go into the finance side of the equation for sure.
Jonathan, how are you helping your client understand what this thing is going to cost, similar to Dan's conversation?
So our deal models, whether it's for an acquisition or a development, get to about 100 pages, right, which is longer than anyone else I've seen. But we start with a basic pro forma. We start with, like, where do we think this market or sub-market is, right? What's the product? If it's a new build, what is it? And we're very cautious about the first 2 years. Right, we see a lot of management company driven projections that show a ramp up of both revenue and of profit margins faster than anything I've seen or experienced in a new build or a substantial development. So in some cases, I agree with their stabilized revenue and income projections. But I think they're not going to get there till year 3 or 4, and they're getting there kind of at the beginning of year 2, which is problematic. But what we do is we we'll grab as much data as we can find, right? Dan's an investor and owner in Lark, which is, if you haven't seen it, their reporting and their projections, market by market, are great. And they're the only one of the major forecasting firms that actually talks about EBITDA and cap rates in addition to occupancy, ADR, and RevPAR for markets and submarkets, which is very, very helpful. But we grab as much information as we can. Individual comps, right? So if someone in the market, even if they're not going to be in our comp set, is owned by a public REIT, about half of the public REITs report their occupancy, ADR, and RevPAR quarterly, and about a third of them also report total revenue and EBITDA margins. We'll grab as much information as we can. Then we'll do the same thing in food and beverage. Understand, what do we have? What's our program? How much meeting space do we have relative to comparables? And do a bottoms-up build-up. Instead of saying, we should have 10 million of F&B revenue because that feels about right, we're going line by line through. Our ballroom is going to be this size. Our junior ballroom is going to be this size, right? Our 4 breakout rooms will be this size. Our 3-meal-a-day restaurant, right, is going to have this many seats, this many square feet, and should be doing this many breakfast covers. How many of the covers are going to be either comped or subsidized because of brand programs that do that? What are we going to do for lunch? What are we going to do for dinner? Right? And we get through the detail. We get through substantial amounts of detail on every one of the outlets and every one of the meal periods. So at the end of the day, someone, whether it's a lender, whether it's an investor in the deal, they can question our assumptions, and I may or may not be right, but I've got backup for every single line item and detailed backup. So they can tell me I'm full of crap when it comes to our F&B revenue projections or profit projections, but they have to tell me which venue, which outlet, like which one do they disagree with. And we'll do the same thing in terms of buildup of occupancy and ADR. We're going to look at as many comps as we can, and look and see kind of where we think we would be positioned initially, and then more stabilized. But we also are going to look at what we think the segmentation in the market is. How much group of the group, how much is corporate, how much is leisure, right? How much contract business is there in the market? What's that going to do? So we do, in addition to kind of a top-down and a comparison to industry kind of averages and standards for that market or sub-market, we're doing a bottoms-up build-up of, here's what we think the business transient, corporate is going to do. Here's what we think the consortia is going to do in occupancy and ADR for a full 5-year period. Great. So we try to get really, really detailed, even though I have no idea what I'm having for dinner on Saturday night.
Todd, Mike has a client. They have a hotel portfolio, 11, 12 properties. One of their properties has a basis of $40 million. Fair market, Kyle has said, is plus or minus $90 million. What are you guys, how are you helping, and how are you talking with Mike and your client, his client, your client, on what's possible? Walk us through. We have, 10 minutes for a 4-hour conversation.
Okay, sure. Yeah, I think it depends on the client, right? Okay. And so we have the sophisticated REIT clients, and then we have the individual operators. What people have to understand about a 1031 exchange is the benefit of a 1031 exchange exists for every dollar you spend above your adjusted basis. So if you have a $40 million adjusted basis and you're selling, I believe you said
$90 million,
right? So as long as you buy for $90 million or more, you're deferring all the tax. If you
so there'd be capital gains on the $50 million. Clients not happy about taking a hit of $50 million capital gain.
Right, and depending on where you are, say you're a New York City operator, the effective capital gains tax rate there is about 37% if you include depreciation recapture, between 37 and 38%. That's a huge chunk of money.
Don't worry, it'll get better with the new mayor. I'm sorry.
Yeah. Absolutely. It's going to get better with him. So part of what we do, what's interesting about being part of a qualified intermediary, I'm an attorney. My colleagues here with me today are both attorneys. Obviously our general counsel he's an attorney and he has LLM in taxation. My partner is a CPA. We're all tax people. But the funny thing about being a qualified intermediary is, unlike being at a law firm, is we're not allowed to give tax or legal advice. So the line that we draw, but I say this with a lot of humility of the whole qualified intermediary industry, we're generally the smartest people in the room on the topic because we have to only know this much of the tax code, where most tax attorneys and the CPAs are a huge amount. So our conversations are more coaching and informational, and they sound like advice. This is, the joke within the industry. What I'm saying sounds a lot like advice, but at the end I have to give you the caveat of I can't give you tax or legal advice.
So this is a method to defer the $50 million in what would be state and federal capital gains.
Correct.
Mike,
State, federal, and even local, like my example in New York City. New York City is 3.88% capital gains tax.
Based on the location of the property?
So there's very few local taxes, so it's normally federal and state. That's why some investments in states like Florida, Texas, no state capital gains tax, and in New York City, conversely, it's a relatively high state tax, 8.82%, and plus the New York City capital gains tax, 3.88%. California is roughly 13-14%.
But is it based on where the hotel is located, the tax?
Yeah, so, well, that's a great question. It's based on two things. It's based on where the hotel is located, the real estate, and then it's also based on where the taxpayer is located. So if you have a New York State, let's just say a New York State owner of the hotel, and they own a hotel in Florida and they're selling it, and they're not going to do a 1031 exchange, and they're going to recognize the capital gains tax. Florida says you don't owe us any tax, but New York says, oh, New York company, you're selling an asset in Florida. Florida doesn't want that. That's okay. We'll take it.
Got it.
So
Mike
you
Pickett,
get paid that
question.
tax.
Well, first Mike has a comment, then I have two questions.
So just one thing to note, Steve mentioned it, this is a deferral. It doesn't mean you're not paying, you're just deferring when you pay, and that becomes really important for some clients. If you're talking about family office, there's legacy, there's estate planning issues. At some point, somewhere along the line, you're paying. We have a client who did a trade into land, entitled the land for data, sold the land for $300 million. So they are now they're looking at a huge tax event because they didn't recognize the gain the first time around. They now have $300 million and they are trading out of that, and they now have $300 million of cash to go buy properties with, and there's a certain amount of time. By what are the time frames? 90 days to identify, and
it's 45 days to identify and 180 days to close.
And so they're doing that at the risk of whatever's happening in the market at the time, right? It may or may not be a good time to be acquiring a hotel asset or an office asset, or it may be a great time, and those factors come into play down the line. They are now being forced. I say forced. They're buying properties left and right now to satisfy the trade that they're doing. Otherwise, they're going to recognize gain, and they're doing that into a market that's challenging. So,
to your point about
First Dan, then Jonathan, back to Mike.
to your point about ultimately you're going to pay, you got to factor in the time value of money in terms of kicking the can down the road.
So I have a question, because all I do is hotel, right? I kind of think I understand other real
Not supposed
estate
to ask
asset
questions.
classes.
Asking the question.
No. It's on topic. Are you seeing like a lot of hotel owners 1031 exchanging into other hotels, or are they exchanging into, like, I've seen a bunch going into like triple net lease, like CVS stores or Walgreens stores or whatnot. I don't think I've seen hotel exchanging into other hotel.
So no, it's a good question. So I would split it up into two different categories. The larger operators, the huge companies, they're exchanging out of hotels into other hotels, and a lot of times what you'll see is if they acquire a portfolio, and maybe they're acquiring a portfolio of 20 hotels, and a few don't fit their profile. So they'll sell those off and buy other hotels within their profile. The other category are the smaller owner-operators. And, you know, what we really see is they're selling, what I politely say is they've timed out. That's a polite way of saying they've gotten old. And they don't want to run a hotel anymore. Running a hotel is a lot like other assets, classes of assets in real estate, like multifamily, where it's tough, it's work. And the reason why they're selling and they're not buying hotels again is because their kids saw with their parents how hard they worked, and they don't want to go into that industry. So you're absolutely right. They come out and they buy triple net lease property, which, if you don't know that term, when you drive around the suburbs, when you see a bank branch, a Jiffy Lube, a fast food place, they're always owned by investors, and there's no management. So if you buy a Burger King signs a 20-year lease and effectively runs that property, and you become a mailbox landlord. So it's very attractive. You go from hotel, where you live and breathe and die every day with that business, to just collecting rent every month.
That's what I'm seeing more of.
Yeah.
Unless you find some schmuck to lease a hotel from you.
Yeah, and it if I could just follow up on one thing I like about the stress of a 1031 exchange, that you have to go out and find property within 45 days. That is a thought process, but also to back it off, to make it seem less horrible, because 45 days is a short period of time. But what you always have is the time period to explore the market while you're selling your property. Then, once you're negotiating your contract, and then you're in contract, and the period between the contract and the closing, plus 45 days. So what I always say is, you look at the sale process and the purchase process as two trains on a parallel track, and you never want either train to get too far ahead of either one. If you manage it correctly, then that's more success. The people that come to me and say, I'm in contract, I'm closing 2 weeks from now, and then you have 45 days, and I haven't started looking at the property, that goes absolutely into your...
That happens, right?
Yeah, and that happens, and then they're up against the wall, you're right. But proper planning, and, you know, all of us as advisors, that's part of our duty. If you're on the side of selling a hotel, is to advise the client not to get over their skis and, you know, just jump right into it at the last minute.
So I have one PSA, one purchase and sale agreement I'm doing right now for 2 hotels where the seller, right, I'm on the buy side, the seller has the ability to exercise 2 30-day options so he can affect a 1031.
Yeah, and that's great if you can negotiate that, and that's a function of the market.
It's not good for me, but it helped me get the deal done.
Yeah, you know, it helps the seller. I always say that if you're unsure of your property still, you want to drag the sale process out as long as possible. But then also there's the risk, right? Bird in the hand. If you keep dragging out the buyer and kicking them down the road, maybe, you know, it's funny. We haven't talked about, you know, that the Fed is meeting today, and the interest rate, that hasn't come up once. I was on a panel last year, and that permeated every single conversation. But if the rates are going the opposite way, and you're kicking the can down the road, you're trying to push the deal off, and then the rates go up, and then all of a sudden banks peel back.
Quick comment by Dan, then to...
All I want to say is,
Mike.
it's a known fact. Time kills deals.
Mike, before we leave the panel, Jeff, where's Jeff? Stepped out. We're going to talk in the next session about gremlins and risk. Jeff's an environmental attorney. He may turn up some issue on that targeted land. We'll talk about that in a minute. Mike, you need to set up this deal on behalf of your client. It's going to be an LLC probably with an operating agreement. There's going to be financing. Before we get to that, though, are you having your tax colleagues talk to Todd about this deal? He's an expert, or do you understand enough, you and Jennifer, in your work representing clients?
I typically let the 1031 people do their job. It's a bit, no offense, but in my world, I shouldn't say it this way, it's offensive. It's a bit rote for me. We put a provision in the purchase agreement, client coordinates with the 1031, we close, off they go. There isn't a whole lot that I am doing for that aspect of it. And most of our clients are sophisticated enough, they've got either internal or other tax people advising them generally. So I don't have to get too far into those weeds, thankfully.
We're going to talk to you about structuring the deal, then to Dan and Jonathan, but you need to structure a deal. You're going to have an operating agreement with the equity investors. We're not going to talk about waterfall, I don't think.
Oh, man.
And then the financing. But set the stage where you can talk about preferred rates, but operating agreement, the deal among the equity investors, and then the loan, and then we'll go to Dan and Jonathan.
All right, so let's just cover some of the basics. Yes, we typically would see a limited liability company as the owner of the property. Typically a Delaware limited liability company. Again, financing comes into play with that question about where that limited liability company is formed. Delaware is very friendly. It's also very finance friendly. In some financing structures, you're going to need to get Delaware special counsel opinions on springing members and authority to file bankruptcy and a whole bunch of bells and whistles that go with, for example, CMBS financing. So Delaware is a known commodity, good place to be. Yes, we work on operating agreements. The operating agreement goes with each LLC, but if you look at an organizational chart for one of our deals, you've got 15 or 20 LLCs in the organizational chain, and you've got sponsor money coming in, that's through an LLC, maybe multiple LLCs. You've got equity coming in, that's through a separate LLC. You may have other sets of tranches of entities involved. So yes, we spend a ton of time on limited liability companies. Forming an LLC takes 5 minutes. I can call my office right now and we'll have an LLC in Delaware before this panel's done. The operating agreement gets really tricky if you're dealing with a sponsor and third-party equity coming, a life company or a pension fund coming in with 90% of the equity. That operating agreement, we spend a ton of time in. There are issues throughout that whole thing, management issues, exit issues, what happens to the promote. I don't want to spend too much time on the promote, but the promote drives our world. And trying to align the interests of sponsor and equity in those operating agreements is a very large component of what we do on the daily basis.
Great. Dan and then Jonathan, let's go over some of the basics. In the lender market, loan to value, where are we on interest rates in general? Either one of you? So it's a $100 million deal all in on the profile.
If you're going to the bank market, if you're going to a commercial bank, they're generally going to cap out at 50, maybe 55% loan to value, right? And that'll also include loan to cost. They're going to require an appraisal. And for the most part, they're going to want to see that against the as-is value, right? The commercial banks aren't going to high leverage. There's an abundance of debt funds out there. Insurance companies, pretty similar, right? They generally don't like heavy lift assets, right? Meaning there's a lot of CapEx and a lot of repositioning. Some light CapEx and improvements are okay for a senior bank lender or an insurance company. The debt funds have a different point of view, right? They come mostly, their DNA and where a lot of these senior professionals come from is out of the private equity business. And they figured out that they can make better risk-adjusted returns, making more leveraged loans and financing their loans, right? So either getting a bank to take a note and ending with a mezzanine loan, or just getting a bank facility and borrowing against their portfolio of loans. So they manufacture anywhere between a 12 and an 18% effective interest rate on the piece that they hold. They can handle additional risk. We're seeing them go to 70% on transitional stuff, in some cases up to 75% on relatively stable. And then what the large banks are doing for non-balance sheet, they're doing a lot of loans that are large at up to 75%, that they're taking the senior position and putting it into a CMBS, right? So they're essentially securitizing the senior position and selling off the mezzanine loan position, and they intend to keep it on their books for 30 days or less.
So Bank of America, let's just take 55% loan to value. That's $55 million on this $100 million deal. Where are interest rates right now before the Fed meeting in general?
So we're seeing kind of a big spread depending on what kind of asset it is and how stable and who the sponsor is. But a floating rate loan is going to price at something like SOFR 275, so 30-day SOFR plus 275 basis points to 350, depending on the strength of the sponsor and the deal.
Dan Lesser, we need to come up with $45 million in equity somehow. Are you helping your clients in this area?
We do not do capital raising. We'll call Jonathan. He does that.
Okay, where are you finding your equity?
Depends on the type of deal. So some of it, for $45 million, I'm typically going to the private equity universe, right? That's an if it's 45 million of equity, that's an institutional sized raise. There are some private equity funds that want to put out 75 or 100 million at a time, but 40 million is pretty good sized. It's kind of generally too big for the majority of family offices, right? They'll invest in their own project, not in yours, unless you're doing it with one of their family members. Then you have a shot. But that's where we're seeing the majority of the equity come from.
Dan?
I'd like to just weigh in, coming back to the debt. There are lenders out there that their thesis is loan to own. So that's a whole nother sort of thing to think about, right? I also have heard the term, Jonathan, you mentioned, stabilized, stable, right? I think it's important to point out that, if you think about it, hotels, theoretically, it's really impossible for a hotel to be stabilized, again, for the mere fact that daily occupancies, right? And then with technology, room rates change by the nanosecond. In a rising market, that's a great thing. In a declining market, it'll kill you, right? So yes, people talk about stabilization. Lenders look at stabilized value, but you have to realize that is at a single point in time, right? So the stabilized value of a hotel in Lower Manhattan on September 9th was very different than the stabilized value of that same hotel on September 13th.
This is one of the areas where hotels are very unique relative to other asset classes. If you're looking at an office building, you've got 15 leases in that building. Those leases are for 5, 10, 15 years. So they're paying that set rent for that period of time. That doesn't change day to day, right? Every tenant in the building vacates their premises every morning in a hotel. So that there's constant movement, and he's right. So when we were talking about the appraisal and the loan to value, there's a big distinction between as is and as stabilized. In the hotel world, that's difficult to try to pin down. But in other areas, multifamily, for example, you can get to an as stabilized type value based on assumptions and pro formas on what you're going to be getting for rents.
To follow up on both those points, right? When we think about sort of what impacts the hotel industry, right? It's a lot of obvious what's going on in the economy, and things do hit the hotel industry harder. And if you just think about it, we have what people refer to as the once in 100 year kind of issues, but we had that with COVID in the 2020s. We had it with the global financial recession in 2008 and 2009. We had 9/11 and the aftermath in the early 2000s. In the 90s, we had the Russian debt crisis, and in the late 80s and beginning of the 90s, we had the S&L crisis and RTC. So every decade in the hotel industry, we have the once in 100 year kind of issue, right? And that's why also to Dan's point from the first session this morning, it's very difficult to time the hospitality market. Now, some people have money that's designed as 3 to 5 year investment hold, right? And that's riskier, right? If you can underwrite things to a 10 to 20 year hold and you have the equity capital that's patient to do that, right? You can ride out a lot of things. You can also be patient in terms of when you buy, right? So when other people are stressed and the market doesn't look good, you can buy at a good basis.
But I think it's important to emphasize underwrite for 10 years. That does not mean that if a capital event opportunity opens up in year 2, 3, 4, or 5, where you can execute and bake in gains, that you won't do it.
Jennifer?
What are you guys seeing on C-Pace as a finance tool? I feel like it's hearing it more and more, particularly in the hotel context.
Can you repeat the question?
Yeah, so the question is, what are you seeing on C-Pace, right? And for anyone who doesn't understand or hasn't dealt with it, right, C-Pace is a financing mechanism. It's a little bit different state by state, but where you can get effectively a super senior loan, right? And it doesn't show up as interest expense. What happens is you get an additional property tax assessment, right? And the CPACE loans are oftentimes 20 years, 25 years. Because they come essentially as a property tax assessment, the pricing is pretty good. A lot of the banks and commercial lenders historically didn't like it because it was a little more confusing, and because if you have an additional property tax expense on your P&L, the net operating income that you're using to underwrite the rest of your debt or a value is lower. It's gotten a lot more popular. A lot of the original CPACE lenders are now either owned by or funded by giants in the industry, by Starwood, by Nuveen, by Prudential, right? So they have enormous amount of capital. And what we're seeing kind of works best is there are the more sophisticated CPACE lenders and the larger ones out there have a few kind of senior lenders, whether it's construction lenders or repositioning lenders that they've done multiple deals with. So they already have paperwork that works, right? Would look sort of like an intercreditor agreement works. And then there are some debt funds that have their own CPACE affiliate, and they'll essentially come to you and say, we can go 0 to 70%, and it's going to be about 15% of the cap stack in CPACE, right? And and the rest is going to be kind of a 5-year floating rate loan. One of the benefits of the CPACE is it sticks with the property, so you can pay it off if you want, generally with minimal, after a few years with almost no prepayment penalty. But it can stick with the property. So if you sell after 5 years, 10 years, if that financing is good, you can leave it in place.
Great.
I think there's a fair amount of education that would need to take place for any of the run-of-the-mill, let's say run-of-the-mill, I shouldn't say it that way, a bank lender. If you went to a regular Wells Fargo loan officer and said, hey, I got this great deal, by the way, there's CPACE involved, he's going to say, he doesn't, they don't want to hear it. It's a bit complicated. And I've been to a couple of panels where CPACE people have gone through the detail of how it's actually a wonderful thing in some instances, but trying to get your loan officer to convince his credit guy that that's okay is it's like saying the word office. It's like sort of they just don't want to have to deal with it.
Sort of like EB-5 also, but that's a whole separate topic. Jonathan's point about property tax, from a valuation perspective, you really should not be deducting the portion of property taxes that services the debt, because that's in fact what it is, debt, right? And doing a value on a property is free and clear of debt.
But it's how the lenders and the rating agencies do it.
For Todd,
like they're doing what's called a look-through analysis, and they're saying we're
maybe the way they
treating
do it, but
this
I'll tell you from a valuation perspective, we don't, unless we're valuing an asset subject to assumable debt. And even though it may be possible to assume, it doesn't mean that it's going to happen, because you may very well run into a bank lender who's going to take the senior position and say, I'm not dealing with this.
Question for Todd and for Mike. First with Todd, you have a client that has a basis of $40 million. They're going to sell their hotel for $90 million. They're going to put it into something else. Can you walk us through, are they going to have, how much cash are they going to have? Do they need to go and find equity partners? Is there going to be a distribution to their partners, their investors? Are they going to have a Bank of America loan for $85 million?
So one of the biggest misnomers in a 1031 exchange is if you're selling for $90 million with a $40 million basis, and let me add something else, and let me say that there's $45 million in debt,
Sure.
to add to your example. A lot of the misnomer is that people think, and I'll say the less sophisticated or mom and pop operators, they'll think you only have to exchange the profit, or you only have to put in the net cash after paying off the loan. In your example, that I added to, $45 million in cash would be left over. The reality is that you have to buy for equal or greater value the $90 million less your expenses of sale and purchase. So when you sell, you might have transfer tax, attorney's fees, broker's fees. So that'll lower the $90 million. But what you have to remember is the calculation of debt. Debt has nothing, the calculation of gain. Gain has nothing to do with debt. The calculation of gain is your sale price minus your adjusted basis minus your expenses of sale. Debt has nothing to do with it. Otherwise, everybody would just refinance right before they sold and say, oh, this is all the money I have left over. So, what they have to buy for is the same amount they sold for, less those transactional expenses.
Great. Mike, you have to educate your clients? You're dealing with sophisticated clients on these topics?
Yeah, they're all over it, even more so than I am. So they come to me and say, we're doing this acquisition, we're doing a 1031. I typically come in actually after the fact. They purchase all cash because they've got this 1031 money. I do borrower side debt work, so 30, 60 days later, they go back out into the market and finance out the cash that they just put in.
Okay. We're getting close on time. $100 million project. We got a loan for $55 million. Your clients have gathered $40 million in equity. They're short 5. It's a real short 5. We talked in earlier sessions about key money is not great money. Talked about Aimbridge taking a sliver is not great money. Jonathan, and then Dan, how are you helping your clients solve this problem?
Yeah, I mean, sometimes you'll take something that's less than ideal if you need to plug a hole, but key money, right? Key money is basically an unsecured loan that gets forgiven over the life of the underlying franchise agreement, and the brands generally, like 95% of the situations I've been in, they write the key money check right after you've completed. Right, so after you've opened and you're operating in their system, right, whether that's a ground up or whether it's a conversion, when you've finished the PIP and like you're in their system, so oftentimes that key money is not there day one. It comes in and might be helpful in your first or second year of operations, but it's not there right away. So one of the things we'll do is we'll try to figure out, is there a way to push the lender a little bit higher? If it's a bank lender, it's tough. If it's a debt fund, they might say, hey, if you need $5 million more, we could advance it, but you're going to provide a personal guarantee on that amount, and it can burn off when you get to a certain debt yield or a certain EBITDA number. It might be, going to the sponsors, friends and family. It might be, it might be trying to shave down your closing costs and transaction costs and saying, okay, we have an interest reserve built in of $3 million. Let's make it $1 million, and we'll guarantee that we're going to top it up when it's needed. So you huddle in a bunch of different ways, but it's always unpleasant. It's always unpleasant if you're $5 million short.
Kyle's not here. Before we get to Mike, most brokers I know on closing day go play golf and turn off their phones because they don't want to get the call saying, we're $200,000 short, we need you to take a cut.
It's called a feectomy. So, you like that? So have you spoken about preferred equity as yet?
Sorry?
Preferred equity?
Go ahead.
Okay.
Yeah.
So that is another place to obtain this slug, this tranche that you might be missing. It's preferred equity is kind of an odd duck. It's the word equity's in it, but it acts in some instances like debt. It gets repaid first. It has a particular maturity date to it, has a higher rate, comes in on the equity side, but it acts a good bit like debt as well. Of course, if you do that to try to plug this $5 million gap that you have, you're now complicating the transaction, and you're going to need your first lien lender to enter into recognition agreements, and there's all kinds of things that are going on between the first and the pref. But that is an option in some instances, particularly in distressed situations where you can get some additional capital to meet the remaining component of your capital stack.
All right, we're heading to the end. finish with Todd, but Dan, any thoughts on anything we've discussed in this panel on getting the funding?
Go rob a bank.
Jeff is back. You got this 1031. Jeff, your team, environmental team, has come up with something on this former Exxon site from the 60s and 70s. This deal may not happen. How do you deal with your client in a 1031 that's facing some stress now?
Sure. One of the things that we have to be careful not to use the word advise the clients. What we give them information on sounds a lot like advice, but we're giving information because we're not allowed to give advice. Is that when they identify replacement property, so you have to identify by 45th day after you sell, provide a list of the qualified intermediaries of properties that you may want to buy. And generally, you're identifying a property and you're identifying backup properties in case there's an environmental problem, there's a title problem that can't be overcome, something like that. And when companies, taxpayers identify, what they normally do, which is a mistake, is identify the best 3 properties they want. And I'll tell you why that's a mistake. Is if you're past 45 days, and that means you can't change the properties that you're going to buy, if you identify the best 3 properties, the chances are that property 2 and 3 have transacted to someone else. They're not available anymore. So counterintuitive is that on the 45th day, the backup properties should be properties that maybe just hit the market. That way there's not as much action on them, or properties that are slightly problematic, odd ducks. That way they're still going to be around if you want to be defensive and still have something available. So that's the way to protect yourselves against environmental, any other type of problem that would stand in the way of acquiring a property.
So we've had clients who have run into problems after properties have been identified, and there's some math involved. Okay, I've got $1 million environmental issue, but I've got a $40 million gain issue, so we'll eat it, and we close.
Jason's going to be here on our next panel. Title, how are you coordinating your escrows with the title company?
Sure. So with Jason, Jason is with Kensington Vanguard. That's our parent company, so we work very closely with the title and escrow company. It's not always our parent company. We work with, we're like Switzerland. We work with everyone, but that's a big part of the job. So there's the quasi-advisory side of our business that helps the clients. Then there's the transactional side, so then we're working with the escrow company.
Great.
But ladies and gentlemen, thank you very much. Got a couple of closing remarks I'd like to just provide everybody and give some thanks to our folks. So a big thank you to all of our supporters. As you see on the screen there, we literally could not do these programs without you. So thanks to all of our supporters. Thank you very much. And then can we give a round of applause to all the panelists that spoke this morning? That was great. And how about a big round of applause to Stephen Shapiro, moderator extraordinaire. And we're going to clap even though he's an Orioles fan. And I'd like to say thank you to the Army-Navy Country Club. I think they did a terrific job as always. So thank you, guys. If you're so inclined, we'd love to see you at our program in May 13th and 14th in Houston. So ladies and gentlemen, we're going to have some last moments to say thank you for joining us.
As stated during the beginning of this presentation, the link to initiate the certificate process will be displayed momentarily. My Law CLE would like to thank you for your participation in today's presentation.